How are you, sir?
Doing fine, sir. And yourself?
Quite well, thank you very much.
Good, good.
So wait as folks come on here.
Indeed. They're loading up.
Yep.
All right. For those of you that are logged in, we're going to give it just a couple more minutes. Still a lot of people coming in, so appreciate your patience. Thank you.
We need like hold music.
Yeah, we do. You want to sing?
No, nobody wants it. You'll start to see people log off if I
Right.
maybe drums. I can do the drums. For next time, though, we'll find some good hold music.
I like that.
We can play in the background.
I like that.
Wait till maybe 6:35, John.
Yeah, 6:35 will go.
Still quite a few people adding.
Yeah.
So.
Exactly. All right, if you just joined us, once again, we're going to hold off just a couple more minutes. We'll get started at 6:35, so in about 3 minutes, as many people are still logging in. Thank you. Hey, Jason, looks like I lost your video.
I'm hiding.
Did you turn your camera off?
I'm just hiding.
Don't do that. You worry me when you do that. It's like no technical snafus, please.
So I was just reading that September for technology is the only negative month historically as far as average return. Pretty interesting data there, yeah.
I believe it.
Really only very few sectors otherwise. Is that the case?
I think everybody also has the memories of 2008 when all the major Wall Street firms were going under and all that old time period too.
Yeah, I had a teach-in today with the team. We were talking about mortgage-backed securities, CMBS, CDOs, all the, what really caused that.
Yeah.
Both, everyone came like, that was really interesting. Not really having a knowledge of.
Tell them to go watch The Big Short.
I did. We talked about that a lot. Yeah. Just the cross-collateralization of mortgages and, things being rated AAA because of diversification, not necessarily because what's inside is good.
Right.
You had all the reinsurers, you had the ratings agencies that were theoretically in cahoots. It was pretty amazing times. Hopefully
it really
we'll do that again.
Really was.
Cool. You want to get started?
Yeah, we'll go ahead and get started. Looks like everybody's logged in that signed up here. All right, well, welcome everybody to our Retirement Planning Amid Market Volatility webinar. We're sure pleased that you're with us this evening. We're going to have a great time with you. As you know, Jason and I are not stuffy guys. We're here to help you and basically talk about the times that we find ourselves in, not only today, but also historically. September, as Jason and I were just chatting off air, historically, September is a tough month in the market, and we've got some stats to show you that. But more importantly, we want to help you navigate it. We want to talk about, again, what is a safe withdrawal amount? How do you handle financial emergencies? Diversification, all these things that you've heard us talk about for so many years. We're going to try to bring it all together tonight and really begin talking about, again, how do we survive and plan for our retirement when we have this craziness going on in market volatility. So with that said, I want to make a little introduction for those of you that don't know us. We're going to go through our intro here and our table of comments. We'll talk about our team and so on and so forth. So my name is John Sanchez. I'm the CEO of Sanchez Wealth Management. I've been in the business about 35 years and absolutely love what I do. And my life was turned upside down about a little over 4 years ago. And this next man that I'm going to introduce here came into my life. And we have just had a great time together. And we look forward to spending many, many, many years together going forward. I think we make an incredible team. As Jason gives you his background, he comes from the institutional side. Obviously, I've been on the retail side my whole career. So those two type of career, trajectories really blend nicely together. Our firm is not large. We manage a little over $300 million. Our clients are our family. We know each and every client. We don't want to be a multi-billion-dollar firm where our clients are just a number. We take great pride in knowing our clients and really feel that we thoroughly understand what goes on in their financial life. And that's really been the secret to our success. I started this business, literally with a phone book, and it has grown, like I said, to north of 300 million. And we're just so internally grateful. I know we have a few of our clients on the call. So to all of our clients, we thank you for being a loyal client, our friends and our family. We truly appreciate it. All right, Mr. Gaunt, Jason Gaunt, COO. I'm the CEO. That's right. COO and CFP. Jason, it's great to have you on the call as always.
I appreciate it. Yeah. So I am a certified planner professional. Joined Sanchez Wealth back in 2020. Again, John mentioned my background predominantly is in the trenches, building portfolios, trading for large multi-asset and mutual fund portfolios, hedge funds, et cetera. So the nice part about our firm is we know how the sausage is made, right? I often comment that being able to speak to clients and truly look them in the eyes and really feel comfortable that what you're allocating to for them is something that you very much know how the process works versus many other firms will be put in front of you and claim that they have a model of some kind that someone peddles to them. John and I work very hard to build custom portfolios for our clients, whether it's through bespoke allocations for tax reasons, for goal planning, for income planning. There is no one size fits all, and we work very hard to make sure that all of our clients feel that way. And hopefully that will be demonstrated a bit with this call tonight. But as we mentioned, we do have a team. The two of us work together. We've got a team here in Reno as well that works hard on the operations and marketing side. So I hate to use the cliche of family, but it really does feel that way. So it's something that I find that our clients truly value, and we do too.
Absolutely. Thank you, Jason. And speaking of saying thank yous, we want to thank my daughter, Bailey Sanchez, Director of Marketing for Sanchez Wealth Management, for putting this together. And then there's a whole team behind her. We want to thank Eduardo and Ashley, just everybody involved. Jason and I have the easy part, right? We get to do what we do best, which is sit down and talk about the markets and the economies and strategies. Again, they do all the hard work. So we thank each and every one of them for putting this together. And again, we're going to make this a monthly series. That's our goal. We've had one. This is our second one. So if you hopefully enjoyed and most importantly learned from tonight's webinar, just let us know. Send an email to info@sanchezwealthmanagement.com and we'll keep you on our list and make sure you get the invites each and every month when we, of course, do different topics. A couple of housekeeping notes. By compliance reasons, we had to disable the chat feature, so you can't just type in a question as you may see on your screen. You may have the ability, but that does not work. It has been disabled. Please, of course, silence your phones. We do have everybody on mute, both video as well as audio. So, just in case something happens where you hit the wrong button, just please make sure your phones are on silence. We're going to be doing a poll here in just a moment to kind of get the ball rolling, so we want to make sure that you participate in that. We'd like to see your feedback. And then at the end, after we go through our presentation, we're going to have a Q&A session. Now, the way you participate when we're ready to do this, you will see on the right-hand side of your screen, there's a hand. It looks just like this, and it says speak. Just click on that, and then it'll pop up on your screen whether you want to join by audio and or video. So you can do either one, and then we'll sit here and answer your questions. And then, of course, let's not forget that Jason and I are available to all of you. If you'd like to sit down with us on a one-on-one basis, as Jason mentioned, not one size fits all by any means. We'd love the opportunity to work with you and discuss your financial planning dreams and goals and retirement planning and market volatility, etc. So we are here for you. Just call the office at 800-1801. We'll have our contact info at the end, or send us an email, and we'll get you on our calendar. We can meet virtually or, of course, in person. Okay, with that said, let's get this ball rolling. So tonight's presentation is really about market volatility. Now, market volatility, of course, is it's kind of a worn out term that's used on Wall Street, right? But what really is market volatility? What keeps you up at night? What gives you the gray hairs that Jason and I get to enjoy because we're taking care of our clients' money? Well, and it's real simple its form. Market volatility is just sudden changes in stock prices, right? And they can cause for a number of reasons. I mean, tonight's timing could not be any better. Look at the volatility we experienced yesterday with the Dow plunging over 600 points, the NASDAQ down over 300, Japan, the Nikkei falling over 4% overnight. And then let's not forget what happened in the markets going back at the beginning of September when Japan had their problems and we had a bit of a carryover effect here. So the causes, of course, can be economic events. It can be political instability, which, of course, we'll talk a little bit about the upcoming election and how it's impacting Wall Street. And then, of course, natural disasters. Knock on wood, we haven't had any of those lately, such as earthquakes or terrorist attacks or anything like that. But I think we can also throw in into this screen geopolitical tensions, right? You hear Jason and I talk all the time on the radio show, which, by the way, for those of you that don't know, remember we changed our time to 3 o'clock. And don't forget, you can pick up our podcast from your favorite podcast distributor at any time. We have hundreds. We've accumulated hundreds of shows on there. So don't forget to go to iTunes, Spotify, etc. But, the causes, Jason, really are multiple, right? Anything that causes extreme market volatility. Let's throw in something we talk about all the time also. Algorithms, right? Something you used to run a lot and deal with when you were running hedge fund type of. So just let your imagination wander, and anything in this time period that we find ourselves in can create volatility.
Yeah, and I mean, that's the difficult part for all of you. Clearly, if you're on this call, you're interested in some of the tumult that we've dealt with most recently, as John mentioned, with issues from the yen causing 12% moves overnight back in early August in the Nikkei. Items like that will become, I very much feel, more common going forward, just because we've been in such a low volatility environment, which means that the daily price moves of the market over the last couple years, I know to use that as a narrow view, have been fairly calm. Coming out of COVID, coming out of the lows of 2022, we've been in this upward move in the market, an upward rally in the markets, which I like to use the analogy of stocks go up an escalator and down an elevator during a bull market. And so when you see these moves, ironically, they are what takes place in a bull market. Is when you see these big volatile down moves in the market, it's because of the fact that of positioning, folks sometimes get complacent in their positions. Obviously, the trend of AI, big data, automation of all things, NVIDIA being a stock specifically that's gotten a lot of headlines, you tend to find crowding. And with crowding, which means lots of people owning few things, which we'll get to later as far as diversification in your portfolio, crowding oftentimes can lead to volatility, sort of using it again, another analogy of everyone running out of a building at the same time through a narrow door. It tends to not work very well. and people get hurt. And so these are some of the things that we're going to talk about tonight is when you're looking at your portfolio, not only the equity holdings or the fixed income holdings or fixed portions of your portfolio that are there truly for income, you want to make sure that you've got diversification that fits with your short and longer term goals. So volatility is going to be something that you need to be comfortable with and make sure that your portfolios are built appropriately so it doesn't cause as much angst if you know that you're properly prepared.
And keep in mind also, for those of you that may not be in retirement or maybe you're years away from retirement, I'll tell you this from experience, of course, seeing this with clients, when you are in retirement, however you feel while you're still working and we have these major market shakeups, magnify that times about 50 once you're in retirement, right? Because you don't have that ability to, continue to work and add to your 401k, your IRAs. You're on a fixed income type of situation. So everything we talk about tonight as far as volatility, magnify it significantly once you're in retirement. That's why asset allocation, working with qualified financial advisors, etc., is so very important when you're in retirement because you don't want to go back to work. We don't want to have to tell you you have to go back to work because of market losses. And through proper diversification, tactical management, things that we really focus on, God willing, that never has to happen. Jason, before I advance to the next slide, I do want to mention one thing. You mentioned AI and I mentioned algorithms. And I think we need to take just a quick moment and let's explain to the audience what we're dealing with, you and I, as far as portfolio managers are concerned, and what people are seeing. They're hard at work every day. They look at their phone at lunchtime and the Dow's up 100 points. And then, they get done with their lunch 30 minutes ago and the Dow's down 500. And they're like, how can so many people buy and sell so quick? Well, let's explain that it's not the people, that it's the algorithms. And that's the competition that really we're facing and really what causes extreme volatility. Explain what the algos are.
Yeah, I mean, again, the algo term gets used in many different ways. As a trader, we used to build algorithms instead of looking at a stock on the screen and seeing the bid ask to say, should I buy 20 shares here or 200 or 200,000, et cetera. You build algorithms that can go in and make predictive decisions for you using historical data, right? And so whether it's going to certain exchanges to find liquidity, both on the buy and sell side, or in the case that we see now, you've got machines that are built to react to data that is streaming both in the markets, but also through the news. And when they see words like recession or rate hike or rate cut or any of those sorts of things keyed off of certain items inside of data feeds, they make reactive decisions in the market without any human interaction. And so we're seeing that more and more and more. And as I mentioned, we'll only continue to see more and more of that. And in fact, given the proliferation of ETFs, exchange traded funds, there are much less of a single stock ownership world and more of a ETF world that is not quite as concerned with underlying stock price of a specific holding. They're just blindly buying or selling a basket of securities in order to keep hedged. And that is something that, as John had mentioned, algorithms, et cetera, those tend to trade fairly fast and they tend to leave a lot of bodies in their wake. And that is, something that is going to continue to happen. Knowing that occurs and knowing that exists, again, in portfolio construction can help you at least better weather the day-to-day where you're not quite as concerned about the ebb and flow of a specific event or a specific market move because you've diversified the portfolio that, as John and I have talked about much before, if it all goes up together, guess what? It's going to all go down together. And so again, those are some of the things that we'll talk about later, but algos, AI, sort of consuming data without humans buying and selling, it's going to only get to be more and more a part of the market. And it's not to be afraid of, it's just to be knowledgeable of, because we use these things too.
I've got some examples. Pardon me for turning my camera off, but I wanted to dig something out of my trash can that I wanted to bring to everybody's attention. I forgot I accidentally threw it away. So follow me just a little bit on this, folks. Then we'll advance to our next slide. Just to show the volatility just today alone. Okay, so I'm going to give you the time and then I'm going to tell you what the Dow is doing. And listen to me when I jump around, and you'll see how fast this market moves. Okay, so at 6:40 this morning, the Dow was up 117. 3 minutes later, it was up 82. 5 minutes later, it was up only 28. Okay, so think about that. Let me jump down to another time period here. At 8:21, the Dow was up 111. At 8:22, it was up 63. Let's see. At 8:56, it was up 40, and at 9:13, it was up only 1 point. Let's see. About 10:01, it was down 35, and by 11 o'clock, it was down 72. And this is just some high points of today. But this is, again, what we're dealing with. And again, use my example. When you look at your phone at 11 o'clock on your lunch hour and you go, oh, the Dow's doing great, it's up. And then you look at it 5 minutes later, 15 minutes later, it's down 200. This is why. It's the algorithms that are doing it. It's not human beings. And remember, the last thing we want to mention, if those of you that are not familiar with algorithms and how fast they trade and the volatility they create, blink your eye. That blink of an eye is a nanosecond. Those computers can buy and sell in a nanosecond. That's how fast they do it. And Jason, they're trying to just make a penny on the trade between the bid and the ask, right? But if they do it thousands of times a day, that money adds up.
Yeah, I mean, it depends. Again, the term algos are used quite a bit. But yeah, the high frequency, like the market makers that you're talking about, yes, they're, so if there's 13 lit exchanges, as in active exchanges, the Pacific Coast, New York Stock Exchange, blah, 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 there's 13 lit exchanges. They'll try to buy on one exchange 100 shares, knowing that this other exchange, they can sell it a penny higher if they're fast enough. And that is what high frequency trading is. Ironically, those dampen volatility to some extent because they're providing liquidity on both sides of the market. It's the algorithms that are keyed off of macro news. And I wanted to stress this too before we go on to the next slide. Certainly the next 3 months to 12 months, right? We're in a macro world now in terms of the market is way more sensitive outside of NVIDIA. The market is way more sensitive to economic data than it's been for the last 10 years. The PCE for inflation, the CPI for inflation, jobs numbers, those are all things that are quick to get and quick to react to versus an earnings release from a company, et cetera, causing all sorts of movement. So you need to be aware that until macro stops dominating the headlines, which it will at some point, and it will become a stock picker's environment, much more so where earnings drive the market. For now, you just need to know that that volatility, given the sensitivity we've got with interest rates, et cetera, is just going to be there. And again, there's ways to look to offset a bit of that too. Right.
We'll explain that. Something you jarred memory-wise. Remember when President Trump was the president, or former President Trump was the president, the algorithms, folks, were set up so whenever he would send a tweet, and remember, a lot of those tweets came out at about 2, 3 o'clock in the morning, the algorithms would react to, as Jason said, to certain words that he said. So if he gets reelected and he, I know he doesn't tweet, he has his own now, but if he is very active in social media, that will just add fuel to the fire from the volatility standpoint. All right, let's move on to our next slide. The importance of retirement planning, right? We're focusing tonight on volatility inside your retirement accounts. We all know the importance of retirement planning, obviously to ensure financial security, maintain desired lifestyle, cover healthcare costs, leave a legacy for loved ones. The list goes on, and I apologize, I have a typo here. But the bottom line is, this is the last chapter of your life in many cases. When we enter into retirement, this is the final chapter. This should be the best chapter, as we tell our clients. We know we're doing a great job for our clients when we never hear from them. We want to hear from them, and we're proactive. We reach out to them. But if they're able to go live their lives in retirement and not worry about the volatility and the news headlines and this and that, and they're out living their lives because they know Sanchez Wealth Management is handling things, and which we are, then we know we're doing the great job. If a client's on the phone all the time with us, which I don't think we have any, to be honest with you, worried about this headline or this move in the market, then something's not right. Either they're in too risky of a portfolio, or frankly, sometimes they shouldn't be in the stock market. We've had many clients over the years who have said, you know what, you've been in the market for a year, you're very nervous all the time, you don't quite get, how we operate. It's best for you maybe to go to the bonds or CDs or something that's not going to give you a lot of volatility. And there's nothing wrong with that, right? The stock market is not for everybody, but if you're going to be in there, you have to understand that volatility is a way of life. And as Jason alluded to, it's only going to get worse as time goes on. So we need to make sure that we have a very secure retirement. Now, we talk a lot about risk tolerance. And let me tell you, folks, there's a million ways that we can assess risk tolerance.
Okay.
What we want to do is Jason's going to show you a risk tolerance questionnaire that we typically will use many times when we start the relationship off with a client. I like to verbally first talk to a client about risk tolerance. And of course, as you see here, the risk tolerance questionnaire, what are the factors? Your age, your financial situation, the investment experience, and then align the investments with the risk tolerance. That's where we as advisors, that's where everything starts. What are your goals? What are your dreams? And oh, by the way, how much volatility can you handle? And one thing I learned many, many years ago in my career was I stopped asking people, hey, Mr. Smith, do you think you're aggressive, moderate, conservative? And instead I say, okay, Mr. Smith, you've got $500,000. Tell me, could you withstand a 10% fluctuation, up or down? Well, you probably love it on the upside, but could you handle losing, $50,000 because whatever event just unfolded? And you go, oh my gosh, the answer is no. Okay, now you're not a moderate risk like maybe you just told me. Maybe you're more on the conservative side of things. And then we'll start our discussion and then begin, again, the portfolio alignment. Jason, go right ahead.
Yeah, and I think contextualizing risk, right? Having sat in this seat for 5 years and trading in the markets for 20 plus, risks are different depending on who you're talking to. The way that I explain risk tolerance to clients typically is sort of twofold. One, how much can your tummy take of the up and down of a market any day, month, week, etc.? That's the sort of normal risk tolerance that you hear about in terms of John saying moderate or aggressive or so on and so forth. The other part that I think arguably, especially in the retirement realm, is more important is what is the probability that you're going to be a forced seller over the next 10 years, right? Because you could have been the most aggressive investor ever. Let's say you're in your mid 80s, right? You're swinging for the fences. You think the market always goes up. You know what? We're just off all-time highs. You're 100% correct to have been incredibly aggressive in the portfolio from a growth standpoint. But let's back this up to 2022, right? S&P 500 down almost 20%. The NASDAQ down almost 33% in 1 year. You may have had a life event where you need to move into a home, or a spouse passes away that you need to sell a portion of, or God forbid, a cancer diagnosis of some kind that makes you need to withdraw a large amount from your accounts when the market's down 20%. So you could be right in terms of your long-term call for the market, but unfortunately, as age gets to all of us, the probability of you needing to access your retirement accounts for more than just simple cash flow could increase. So that's the other part of risk that I try to think of when I'm talking to folks, and really contextualize. Oh, I can take this much 10% or 15, and then when I show you it's $150,000 to $250,000, you tend to see folks change a little bit on what they're comfortable with. So make sure whoever you're working with isn't just saying, are you aggressive or not, but really gets to know you and also what potential life events during the next economic cycle can affect your retirement.
And you may or may not be surprised about what I'm about to tell you, but just so happens that when the markets are doing well, what do you think everybody answers? Oh, I'm aggressive. And when markets are doing lousy, I'm conservative, right? And so this is how you test yourself. When you do get into a challenging market environment, and let's say you're down 10, 15, 20% in a portfolio, which, by the way, folks, 20% loss in a month these days, that is the world that we live in. So you have to be prepared. Okay. Yep. But when those tough times happen, you hear us talk a lot about this on the show. This is when you do a self-analysis and you be honest with yourself and say, hey, you know what? I'm down 20%. How do I really feel? Like Jason said, the tummy test. I call it the sleep test. In other words, how do you mentally and physically feel? Because we know losing money, you can physically get ill by doing so because you're so stressed out. Did you lose 20% and you go, hey, you know what? Got a quality portfolio. Over time, market goes up. I can ride this out. Or did you go, oh my God, my retirement dreams are blown up. They're out the door. Maybe I was thinking of retiring next month. Now I can't because I just lost 20% of my 401k. Do a thorough analysis, and I'm going to take it one step further with you. If you have a significant other in your life, you need to do this analysis with he or she also, because how you feel and how you react to market volatility and losses, your spouse or your significant other may not feel that way. They may be completely opposite. We see it all the time when we have these risk tolerance conversations with clients. One person may be really aggressive and the other may be moderate or conservative. Again, that's our job to say, okay, where's the happy medium for both of you? So always make sure you include your significant other in the risk tolerance conversation. Okay.
And those are some of my favorite when we have significant others in the room, because you get some great color, you get some great answers, and the more info we get, the better and more sort of concise we can be around your plan.
And please, 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 I beg of you, please be honest with your advisor when you have these conversations, especially us men. What do we have? We have big egos, right? Women usually don't have big egos. Us men do. Last thing we want to do is say, oh my God, John or Jason, I'm conservative or I'm moderate. Men usually are like, oh no, I can aggressive. I can handle any type of market volatility this thing throws at me. This isn't a time to have ego. This is your hard-earned lifetime savings. If we're talking 401ks, IRAs, etc. So be honest with yourself. Be honest with your significant other. Now, once we know what the risk tolerance is, and this is for hypothetical sake, say, okay, we conclude that you're a moderate risk. You can withstand maybe 10% fluctuation. Now we start designing the portfolio. We say, all right, how are we going to diversify this money? Because I love Jason's analogy. If you have a portfolio where everything goes up at the same time and everything goes down, you're not diversified, right? You want to have some up, some down, some up, some down. And we are fortunate enough to have institutional relationships with fund managers and strategists that actually have portfolios that they're designed. Doesn't always work, but a lot of the times it does. Portfolios are designed to go up when the market goes down. So that's how one of the many ways that we will diversify our clients' portfolios is we have things in that portfolio. Again, when the market goes down, they will hold steady or even go up in value. So there are many, many different things and different strategies that are out there. But why do we need to diversify? It's obvious. We need to spread that risk among different asset classes. What do we mean by asset classes? Stocks, bonds, mutual funds, small business, real estate. The list goes on. We don't just deal with stocks, bonds, and mutual funds, right? Our name, Sanchez Wealth Management. Wealth is, we don't care how you build your wealth or how you produce your retirement income. We just want you to be able to be successful at it. So we surprise a lot of clients. Many times we'll recommend that they go into real estate as part of their diversification strategy. We'll bring our team on, Corey and Dwight, that you hear on the show on Tuesdays and Thursdays. We'll bring them on and say, hey, you know what, guys, we think a single family rental or a commercial property is in the best interest of the client for this portion. Or sometimes I've given up, millions, or not millions, but hundreds of thousands of dollars in money that we could manage because it was better to refer them over to Corey and Dwight and get them into real estate. It was a better match for them. So again, we don't care. Now, most advisors aren't going to do that, I should mention, but we don't care where the money goes. We just want it to be successful for you. And what is the goal? The goal of diversification, of course, is to reduce the impact of market volatility. So you notice that we keep coming back, market volatility. Now, what can we do? Well, as you see on the slide here, stocks, bonds, real estate, cash. We can go domestic, we can go international. And then one of our favorites, and that's why we like using ETFs or exchange traded funds, we can nail in and what we call laser focus into certain sectors and industries for diversifications. Now, I'm going to turn it over to Jason, but before I do, keep this in mind, folks. When I started in this business nearly 35 years ago, it was really simple, right? If the U.S. markets became choppy and started to go down, we'd shift the client's assets to international. They worked in non-correlated fashions. That doesn't work anymore. We're one big happy global family. So what you will generally see, not always and not direct correlation, but pretty close, is when we start to have problems because we are the world leader, you will see that find its way over to other markets. Now let's use Japan as an example. as I mentioned just yesterday or last night, the Nikkei closed down over 4%. Well, we closed down a couple percent, so they were much worse. So you will see that impact. But the point is, don't think that you're going to be completely non-correlated and completely diversified because you got a little bit of money in Japan and Vietnam and Europe and so on and so forth. We tend to all be, like I said, one happy equity family. And so that's why we have to look at other assets like annuities and bonds and different things like that, where, again, they don't have really any correlation to the equity markets. Jason?
Yeah, and so even taking it a step further, right, from the quantitative side, right? So there's stocks, there's bonds, real estate, right? So, but even internal to stocks, you've got sectors like we talked about, technology or real estate or industrials or healthcare. But now even what's another area? There's styles, okay? There are quality baskets of companies. There are growth baskets of companies. There are size or small cap bias to certain types of companies. You've got momentum to certain baskets of companies. So now you're not just saying, does this thing make, is it a technology company, but more so, what are the underlying fundamentals, or what is the underlying recent stock movement, or are they raising their dividend or decreasing their dividend? You've got all these other ways to diversify, not just, is it tech or not? Is it a consumer staple or not? And then we add in other things, and getting a little nerdy here, talking about trend following, right? Where we mentioned momentum. We've got strategies that we use in clients' portfolios that don't care what they're buying. Stocks, bonds, grains, oil, yen, euro, you name it. If it's going up, they can buy it. Same thing on the flip side, if it's going down, they can short it. They can make money as certain asset classes are losing value. Some strategies, as John mentioned, were up 15, 20, 30% in 2022 when the market was down a like amount. And those are things that we want to have inside of an account for diversification. You mentioned volatility. We literally have strategies that reduce exposure when volatility increases, right? We talked about what is volatility. If a price moves this much, it's not very volatile. Your probability of losing this much is very, very low. But as that price daily starts to move, the probability of losing this much increases quite a bit, because the fact that a normal move is a heck of a lot bigger now. So commensurately, you don't need to have the same amount of exposure in the market because the risk is now higher. And those are all things that you should be thinking of when you're designing a portfolio, not just, do I own more of company X or company Y because I like them? It's, does company A or company B or company X or company Y diversify against each other to help me build a lower risk with a higher probability of return? And that's what we try to do for folks within their risk allocation.
I want to go a step further as far as this diversification idea with our institutional partners. So I'm going to give you an analogy. Let's say you decide you want to build a custom home. What's the first thing you do? You hire an architect and then a general contractor. So let's say you met with the architect, you designed this beautiful 3,000 square foot home. Now you hire your general contractor. Once you sign the contract with the general contractor, what he or she is going to do is go hire the subcontractors, the framers, the painters, the concrete folks, etc. We do the same thing, but with money. Okay, so we call ourselves the manager of managers. With our institutional partners, Jason and I put our knowledge together and we will build a customized portfolio for our client. So I'm going to make the numbers really simple. Let's just say it's $500,000. Okay, we will then, instead of trying to be stock pickers and ETF pickers, we're going to be manager pickers. And so what we will do is we will hire out of a list of over 200 institutional managers that have been completely vetted and verified and monitored daily by our institutional partner as well as us. What we will then do is say, okay, manager X, we're going to give you 20% of our client's money. You're to manage, you're a large cap manager, big blue chip. Manager Y, you're an international manager. We're going to give you 10%. And so on and so forth until we accompany, basically a 98% investment. We leave a couple percent in cash on normal. We then monitor those managers to make sure that they are hitting the returns and the risk that we feel is appropriate for our clients. If they don't, We have a meeting with them, and guess what? If we don't like the reason for the lack of return or whatever it may be, we will fire them and hire another manager, all at no additional cost to our clients. And so that's how we manage the diversification, is by hiring these institutional managers that, frankly, to be honest with you, you would not have access to unless you had about 25 to 50 million for most of these managers. We can get you into managers for as low as $10,000, believe it or not. But this is the way that the wealthy, the billionaires of the world, how most of them have their money managed. They don't try to, hire a broker to be a stock picker or go buy the best mutual funds, ETFs, stocks, etc. They hire managers, because these managers, folks, spend significant sums of money on research. Some of them spend literally billions of dollars trying to build their portfolios and monitor and watch all the different holdings that are in the portfolio. We don't have that kind of budget, and we never will. So why not hire the best that are already doing that? And that is really how we accomplish the diversification goal for our clients, is hiring these different managers. And then, Jason, we just don't hire them. We manage them, and we make changes when necessary. Not only, I want not to mention, lack of performance, which again, we've only had to fire one manager, but let's talk about changing managers in regards to market conditions changing. This is what we call almost tactical management.
Yeah, and the irony is the manager that we got rid of was too conservative. It wasn't anything they did poorly. It was just a lack of risk taking when we wanted them to. But the tactical aspect is sort of as you touched on. We're constantly monitoring. We have calls with them. We literally have a call tomorrow with one of them. I also have many sheets that are built live that we're monitoring daily performance, so on and so forth. So it is far from a farm it out and set it and forget it, because your assets, your allocation, your goals. I'm not being a sales guy to say that they are incredibly important to us, because John's name's on the door, right? And so we work our tails off to make sure that you're getting the best experience that you possibly can. And again, this is something that we continue to iterate on, and nothing is set in stone. We're always looking, having conversations, deciding as to what shifts we should make given the shifts that are taking place in the market over the next 6, 12, 18. And we're looking to be front-footed instead of reactionary, because that's what we're paid to do.
Jason, I think you froze, so I'll take it from here till your signal comes back. We don't need to spend a lot of time on this asset allocation. We pretty much covered this again, because aggressive, adjusting allocation based upon age and goals, and regularly reviewing and rebalancing. I do want to hit on this one point right here, and that is the reviewing and the rebalancing of the portfolio. Jason just used the term set it and forget it. That is not us. Set it and forget it is competition. We don't believe in that strategy. We think that markets are changing all the time, economies are changing all the time, and your life is changing all the time, right? You may have come to us 10 years ago when you were still working, and we all agreed that you were a moderately aggressive investor. Well, guess what? You're in retirement now. You probably don't want to take that amount of risk since you're no longer working. So therefore, we need to adjust. And in communication with your advisor, whether it's us or any advisor you have, is very important. If there's any life-changing events in your family, please let your advisor know. We legally have to know what's going on in our clients' lives, and we make a lot of our investment decisions based upon that. Your tax brackets, and again, with things that are going on. Unfortunately, I've had it over the years where we've had a few clients where basically we've seen it where a spouse has passed away and the client doesn't tell us for a month or two later. Like, oh my gosh, you've got to let us know these things. So communication is absolutely important, and that's why the regular review and the rebalancing of the portfolio is so absolutely critical. Jason, if you can hear me, for some reason we've lost your signal here, so maybe log off and come back in. Oh, there you are. Okay, all right, very good. Anything you want to add on the asset allocation side of things?
No, again, I think we've certainly beaten this horse. You want to be dynamic, but you also don't want to be reactionary, and that's part of what sets a good portfolio apart, that you've got multiple strategies that are doing different things all at the same time, but hopefully sort of coalesce in a superior return, lower volatility portfolio.
Beautiful. All right, now let's get to another major area of retirement planning, and that is when that time period comes that you are retired, and we've ran a cash flow analysis for you, and we've determined how much cash flow you need to sustain the lifestyle that you want. The next big question is, What percent can you take out? Let's not talk dollar amounts. Let's just talk percentages. Now, I'm sure many of you have seen all different types of percentages, 2%, 4%, 6%. It really varies. There is not one size that fits all, okay? And the reason I say that is this. Your withdrawal rate is based upon a number of factors. Number one, what is the composition of your portfolio? If you are a very aggressive investor, maybe when times are good, you can have a higher withdrawal rate than when times are bad. When the economy is doing very poorly, do you want to still take out the same withdrawal percentage as you did when the economy was doing very well? So this withdrawal rate is going to change a lot with what's going on in the markets, the economy, and really the diversification and the makeup of your portfolio. If you're very, very conservative, let's say you have 85% bonds and 15% cash, you probably aren't going to be able to do a 4% withdrawal rate and expect your portfolio to grow. So, what's the range? I think is probably the most important thing. Anywhere between 4 to 6% is generally a doable range with a well-diversified, actively managed portfolio. Now, the dynamic withdrawal, you adjust based upon market conditions. And again, we never want to have to go to a client and say, hey, you were taking out 10% when things were good, but we need you to cut down to 2%, because essentially what we're telling them is you need to change your lifestyle. And we don't ever want to do that. And then this last one, the bucket strategy. Have you ever used that before, Jason? I've played around with it over the years.
Time with it. I find that clients tend to bucketize their assets, right? Where this is for this, and this is for that, and that is for that. I try to look at everything holistically. Ultimately, we want to invest things differently, but unless someone specifically wants a short-term bucket or a long-term bucket, we tend to sort of overall allocate the portfolio given the neutral range or what their risk tolerance allows for, and then make changes over time. So a couple numbers here as we're talking about, historical returns. So a 70% stock and 30% bond allocation going back to 1930s has averaged about a 9.4% return. That's the annualized return of a 70-30 portfolio. So using John's 4% assumption, even if the worst year being down 30%, if you're taking out 4% and the portfolio is annualizing at 9%, you probably are fine. You don't need to make adjustments to your strategy. Whereas a more conservative, a 40-60 type allocation may be higher, in the mid to high 6% return annually. That if you're taking 4% and you see a drawdown, you may be in a spot that you don't want to be taking quite as much because you're now hitting the portfolio pretty darn hard when it's down. So those are the items that go into some of the simple risk allocation methodology, is expected return and necessary withdrawal rate given your unique retirement circumstance.
Jason just used the word risk, R-I-S-K. I'm going to give you another word, risk, R-I-S-C, which stands for our acronym of Retirement Income Savings Calculator. This withdrawal rate really comes down also, as I said many times, and Jason has said, the allocation, the management, etc. So risk is a Retirement Income Savings Calculator. This is a program we created years ago. And I invite all of you to go to our website, sanchezwealthmanagement.com, and you can find the risk program on there. And what risk is, it's a very unique way of looking at your withdrawal rates. Now, the essential components behind risk is actually very simple. Instead of saying, I've got again, $100,000 portfolio, I'm going to take 4% out of it, or $4,000 a year. What we do is we reverse engineer it and say, how much money does this client need to live? And then that helps us determine the withdrawal rate and the portfolio composition. So what risk does, if you can visualize a cross, and the upper left quadrant of that cross are your fixed income sources. So that'd be pensions, Social Security. The upper right quadrant are your fixed expenses, things like a mortgage, a car payment, etc. The program will then net those two out and tell Jason and I, do we have a surplus or a deficit in the fixed income / expense component of the client's life? The bottom left quadrant is variable income, maybe part-time business, portfolio income, those type of things. What is that number? And then to the bottom right of the cross, what are my variable expenses? Groceries, clothing, beauty care, so on and so forth. Same thing. The program will net those two together. Then the program will take all of your expenses, fixed and variable, all of your income, fixed and variable, and net that out and say, this is what the client's income should be in retirement. Okay. Then we back out taxes and they can see approximately what their net income is going to be. Once we know that, then we validate with the client and say, okay, the program is showing you're going to be net positive $3,000 a month. Is that enough? Some clients will say yes. Others will say, no, I really need about 6,000. Great. That again helps us design the portfolio for more, maybe higher risk it's going to take to hit a higher withdrawal rate, right? So there's many components that go in. Don't just stick to 4%. That's it. Nothing drives me more nuts than, you'll see various news publications come out and go, oh, the 4% rule. Well, guess what? When the markets were lousy in 2022, like Jason said, that 4% rule became the 2% rule. So it always changes. And so the point I want to get across is don't say it's 4%, 5%, 6%. It depends upon your risk, portfolio composition, and most importantly, the management of your portfolio, right? And the last thing I'll mention on this is one thing we love to do with clients is, we'll establish a withdrawal percentage like we indicate here. Maybe it's 4, maybe 5, 6, whatever it may be. But also keep in mind, when market conditions are favorable, like let's say last year where the markets did extremely well, we'll always tell our clients, look, if there's something in your life, like maybe you want to take that lifelong trip with your family, you want to take them to Disney World, or maybe you want to go get that new motorhome or that new car, whatever it may be. Guess what? There's nothing wrong if you had a good year, 20, 25% return that year, taking a little bit of lump sum money out. And again, this is where the advisor's experience comes in, and they can go, look at, 25 grand is really not going to impact anything. You've got, $1 million in your account. It's not going to really affect anything. It's not going to affect your withdrawal percentage. Just keep in mind there's flexibility there, okay? This is kind of like your paycheck. This withdrawal percentage is your paycheck. The lump sum withdrawals, as we call them, those are your bonuses, right? Obviously, you don't want to take big lump sum withdrawals when the markets are down and so on and so forth. So just keep in mind there's a lot of flexibility that you have there. All right, creating a contingency plan. Jason, take this one started off.
Yeah, this is one of my favorites, right? Is ultimately when the term of emergency fund or emergency savings account, I often call it pillow money. Really what you're trying to do is make sure that you have assets set aside for the unknown and the potentially known, right? The water heater breaks, or you have a car issue, or something that you need to spend money because you need to go visit a sick relative or something along those lines, but you've got cash freely available with no risk associated, hopefully earning a return in a savings account or something along those lines that are there. So you don't need to tap into your retirement income, especially using that last slide. If you are getting a paycheck from your retirement, that may be tight for you, right? And ultimately we do everything we can, but clients come to us with all different financial shapes and sizes. Some have an abundance of cash, too much to the point that I literally had clients, what am I going to do with all this income from X, Y, and Z in a retirement account? Because now our RMDs are potentially going to go up, jokingly, to folks who are very tight when they come to us and are just looking for help, right? And so the first thing that we try to do is make sure that you've got a buffer of some kind, that you don't need to go and derail your plans for long-term because of a short-term phenomenon. And that contingency plan for healthcare, other life costs that may come up is something that we certainly stress. Some will say 3 to 6 months of expenses. Some will say 3 to 6 months of income. That really comes from you as to what will help you feel the most comfortable. And then you're able to ride out some of this volatility. The day-to-day up and down of the market doesn't cause you to be up and down, walking around your bedroom all night because you're worried, and people do. So that is, again, something that's very important to know, that, look, if something happened, I'm going to be okay, and go from there.
The insurance coverage is extremely important also, folks. You talk about a way to derail a retirement plan, a major medical expense, whether it's, major medical bills, whether it's being put into an assisted living, a long-term care facility, Alzheimer's care, so on and so forth. So we are big advocates, and this is something also that we do for our clients. We talk to them about what's going to be your health coverage, what's the cost. For those of you that may not know, if you're pre-Medicare eligible, meaning you're younger than 65 and you've left your company, remember you can get COBRA. Usually that's for 18 months. You got to pay out of your own pocket. Usually it's not as expensive as to going out to the open marketplace and buying your own insurance. But we have seen many people that didn't have COBRA or they weren't Medicare eligible have to go to the private marketplace and buy their insurance. And you've heard us say this many times. It's not uncommon to see $1,200 to $1,600 a month is the cost for a kind of a basic medical plan with a very high deductible. So we are, in our calculations, our financial planning, our asset allocation, as well as our cash flow analysis, we have to factor that in. That's a major bill. It used to be, basically what a house payment is. Life insurance, a whole nother topic. Disability, a whole nother topic. One that we didn't put on this slide, we should have, long-term care. Folks, this is one of the best investments you can ever make. Average cost right now about $4,500 last time I checked in Northern Nevada for long-term care facility. Kind of an average facility. Go down, over the Sierras down into the Bay Area, you're talking $10,000 to $12,000 a month is what we've seen with clients. Long-term care these days is not anywhere near the expense that it used to be, because after the financial crisis of 2008, these insurance companies, first of all, we had a lot of companies get out of the long-term care marketplace. The handful that are remaining, literally it's a handful of major players, like about 5, they've combined life insurance with a long-term care rider. And what that's done is dramatically decreased the cost of long-term care. And so there's great new ways, instead of just buying a pure long-term care policy, which is very expensive. Now we do a hybrid of life insurance with a long-term care rider, and it's dramatically brought down the annual premium cost. And again, this is part of the financial planning process. We'll try to factor it into where, see if we can generate enough income off the portfolio to help cover that long-term care cost. But keep in mind, just do the math. Let's round the number. Let's say $5,000. The average time in a long-term care facility is 24 months, 2 years. So $5,000 a month, that's $120,000 a year. Ask yourself, do I have enough liquid assets that if if me or my spouse has to go into long-term care, do we have an extra $120,000 laying around? The answer is probably no. So if that's the case, again, we can help you with long-term care and add that to the portfolio. Again, one of the best investments you can ever make. Professional guidance. Well, again, we are obviously big advocates because that's what we are. But whether it's us or anybody, we don't care, right? We just want you to live the retirement and have the life that you want. What are you looking for in a financial advisor? We get this question all the time. You want personalized advice. As we said at the beginning, our clients are our family. We're not huge. We have a family environment. We know our clients. Expertise in navigating market volatility. As Jason and I said, we have combined north of 50 years experience. So you want a team that has got a few gray hairs. You don't want some kid that's right out of college. We hear this all the time. Oh, I opened an account, with XYZ online brokerage firm, and I call up and I talk to one kid one day, and the next day somebody else. Yeah, those are, Jason started his career there. He can talk better than I can. They're revolving desks. If you have a serious amount of money and you want a relationship, hire a financial advisor that you can build that relationship and that rapport with. Emotional support and accountability. I can't stress this enough. I always joke with clients, when markets get tough, economies get tough, we're about 95% psychiatrists and 5% money managers. And it kind of reverses, when things are good. But a lot of times you need that. People need to be talked off the fence, right? They want to make dramatic decisions. You've heard me share this story many times. In the 08-09 crisis, I had a client call, very successful business owner, she and her husband. And she said, and again, this was when the markets were just plummeting. And she called me up. She goes, I was just watching Fox News, and they said, literally, take all my money out of the banks because all the banks are going to collapse. Take it out of Wall Street. All the firms are going to collapse, and go bury it in the backyard. John, do you think that's a good idea? And I had literally bite my lip and not laugh and say, well, first of all, bad news sells. Remember, when the markets get bad, the press is always going to blow everything out of proportion. That's where your personal financial advisor is going to come in and go, look, I know your situation. you're fine. Or you know what? We need to make some changes, right? Jason and I today made some major changes. We don't have to call our clients to make those. We have discretionary authority. They're off living their lives, but we're managing their money for them, right? That's what you want. So emotional support and accountability. Jason, take on the next points in regards to how to choose.
Just adding there real quickly too. We're here as a sounding board for everything. We're not just stock market junkies. Like the number of things that I talk to folks about far exceeds anything remotely near financial, right? It's, we both try to view ourselves as sort of Switzerland. I'm a neutral party for you to vet things. My line is always, my job is to poke holes in your dreams, right? And I mean that affectionately. That's who we are. We see enough, we get enough input from so many different sources. We've got a good view on lots of things. So that's another reason why I would argue that emotional support part far exceeds what one would expect. And we both enjoy doing it. And that's a big part of why we are who we are. But credentials are important. Certainly someone who's done the work to show that they want to have a higher learning and continue to learn. Experience, references. Our clients are our best referrals, right? Our clients are our best marketing engine that we have, because we try to provide them a consistency and help them through everything that they go through pre and through retirement. So that is a big, certainly something as you're looking for an advisor, whether it's us or anyone else, is to make sure that their goals align with yours, and that their team and consistency is something that you think you want to be with for a while.
Absolutely. All right. Folks, that is it. Here's our contact information. I'm sure you already have this, but if we can be of service to you in any form or fashion, by all means, reach out to us. There's our phone number, our website, as well as our email. Jason and I see the office at Sanchez email, even though it goes to our staff. And we'd love the opportunity to work with you. That wasn't the purpose of tonight's webinar by any means. Hopefully you have learned a lot about what we deal with on a daily basis, dealing with market volatility, dealing with retirement planning, and the real life issues, right? You're not a machine. We're not a machine. You have emotions, you have feelings. And again, an experienced financial advisor will understand you. And again, not be afraid to tell you, you know what, you're wrong. I can't tell you how many times we've had to tell a client they have an idea. It's like, you know what? We don't agree with that. And then we have a healthy discussion about it. We're not yes men. We don't expect our clients to be yes men. We want questions coming from them, because we want educated clients. We want people to understand what's going on. That's why, frankly, we do the radio show every single day. It's our way of sharing. Please check out all of the blogs that Bailey has done such a great job putting on our website. We're just trying to send out more and more educational information that we possibly can. So with that said, let's open it up to any questions you may have. All you need to do, again, on the right-hand side of your screen, you see a hand, and just click the hand, and you'll pop up here.
And also, just throw a quick poll out there for anybody who wants to fill in. What's your view on the market over the next 12 months? Feel free to click and add your data, and we'll share with you at the end. Just kind of highlight. We talked about volatility. Right? It'll be interesting to see what folks who are listening to the call may view in terms of what they think the markets are going to do. And you'll be surprised to see that there oftentimes can be different answers to this question.
Absolutely.
John and I get asked this question all the time. So.
Well, a lot of that, of course, is going to be attributed to who wins the White House. Jason, we've got to do a webinar. Time is running. Maybe we do it next month and talk about, the difference in the economic plans between Biden and Harris. I mean, not Biden, Trump and Harris. They are, I was reading some documentation over the weekend, and they are significantly different. I think people don't have any idea how different that they are, and it's evolving almost on a daily basis. We just learned yesterday that Vice President Harris is proposing $50,000 to people that want to start a new business. That's on top of the $25,000 she wants to get people to buy a house. Sounds great. It's a great vote getter, but in reality, can it happen without escalating the national deficit? The answer is no. So what are they got to do? They've got to raise taxes. So nothing is free in this world, and everything comes with a price. But again, we will do our best to try to educate you and let you know, our opinions and really what the facts are out there.
And we've highlighted too that most of the data that we have that we've compiled really in all cases tells you not to freak out regardless of who wins the election.
Right.
I say this in the nicest way: the markets don't care. certainly in the near term. Longer term, they may, based on tax policy or something along those lines. But we stress to you, whether you're a client or not to let your political affiliation affect your retirement plan, and not make sort of rash decisions if A wins or B wins, as far as the selection is concerned. So as far as the poll numbers there, I don't know if you guys can see that, but a resounding 75% are saying that they think that the markets are going to be between down 10 and up 10. We didn't have anyone who was higher than 10% or even 20%. Couple who said we could be down more, but at least shows you at least where some of the folks who are voting are thinking in terms of the markets. And I would argue if I'm voting, that's exactly what I would choose too. I think there's enough tailwinds from the Fed lowering interest rates, which we expect 3/4 to a full percentage here in 2024. Inflation having come down, the economy still at a low 4 handle on unemployment. Obviously, we're going to get some jobs numbers here pretty soon that'll give us a little more clarity as tailwinds, and headwinds clearly being the geopolitical, a slowdown that the Fed is certainly trying to cause to happen in order to affect that reduction in inflation. And then the election, which will certainly cause some volatility, but still are very optimistic that things will be better into next year, regardless of the outcome of the election.
Absolutely. We'll leave you with one final thought. Market volatility, of course, affects your investment accounts that you may have with other financial advisors, etc. But remember, for most of you, your two largest assets are your home and your 401k. What many of you may not realize is that your 401k can be actively managed. You can make changes in that 401k. You should, and by law, your 401k needs to give you somewhere to duck into, meaning out of the market. So a capital preservation, they call it, a money market, so on and so forth. So those are available. But also, I want to leave with one point. A lot of people are not aware of this. We just did this with one of our clients today. He started building up too much money in his 401k, and he was able to perform what's called an in-service withdrawal. If you've never heard the term, I'll tell you in about 20 seconds. Some plans like NV Energy, IGT, if you work there, some of the larger local employers, there's a provision in the 401k plan that says even though you're still working for that company, you're allowed to take out a portion of your 401k and transfer it, tax-free, by the way, to an IRA account to be professionally managed by someone such as Jason and myself. We really recommend doing this because 401k plans, you're limited on your investment choices. Most importantly, there is no active management. Your 401k custodian is not actively managing your account unless you're paying an additional service, which most people don't do that. So if you have a large sum of money and there's volatility going on in the market, keep in mind that is, again, one of your largest assets. Most plans will allow you to take out 90 to 95% of your 401k and move it to an IRA. You're more than welcome to self-manage it or hire an advisor to do so. But I just want to throw that in, Jason, because a lot of people think, hey, I can't touch my money in a 401k until, I leave the company. And that's just not the case. Just check with your HR/your plan administrator. Say, hey, do I have an in-service withdrawal feature available? And if the answer is yes, we'd love to sit down and talk with you about it. We do tons of these, and they're very, very simple. And again, there's no taxes or anything to move that money out. We'll sit down and determine if it's the right thing for you. Sometimes it is, sometimes it isn't. But we just want to give you that bit of knowledge there.
Wonderful.
All right. Well, it looks like all of you are quiet. You're probably tired, hungry, so on and so forth, and there are no questions. So with that said,
and send us an email to office at Sanchez Wealth. Again, this is not a solicitation. We just want to make sure that folks are aware that we're here. If you have any questions about volatility, concerns about your portfolios, concerns about the markets, but we're neurotic about answering emails. So if you have any questions, you know where to find us.
Absolutely. And as I said on the radio show, all of you that attended tonight, you have access to us. So we will sit down with you, each and every one of you, as our way of saying thank you for attending tonight's webinar and go over your situation. Just our staff will tell you when you call in what documents we need for our review, et cetera. But we will meet with you and discuss what we can do to help you out. Or sometimes we'll just say, you know what, you're doing great. Hey, Thank you. You know, and we love that. We love when we can tell people you're doing great. You don't need us at this point. So again, it's all about you, not about us. So once again, we want to thank you. We want to thank our staff for putting this together. It was a lot of fun. I look forward to next month. I don't know what our topic is yet, but stay tuned, and we will definitely let you know on the radio show and through social media what that topic's going to be. So God bless. Thanks all of you for attending, and we'll see you next time. Take care.
Thank you.